How is the multifamily real estate market evolving with strategic partnerships and large-scale investments? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. In a significant development for the Canadian multifamily real estate market, Starlight Investments has announced a major acquisition plan in collaboration with CIBC Asset Management. According to a recent article by Don Wilcox on the Real Estate News Exchange, Starlight is set to acquire $750 million worth of purpose-built rental apartments through a newly established vehicle called the Starlight Canadian Core Multifamily Fund. This initiative is in partnership with funds managed by CIBC Asset Management. The fund, which is open-ended, aims to focus on acquiring and managing high-quality, income-producing multifamily rental properties in Canada's largest urban markets. It will kick off with an initial equity investment of $415 million from CIBC-managed investment funds. This substantial backing will facilitate the acquisition of $750 million in rental properties and is expected to scale further through additional investments from institutional and accredited individual investors via a feeder fund managed by CIBC Asset Management Inc. Daniel Drimmer, the founder and chief executive officer of Starlight Investments, expressed his enthusiasm about the strategic partnership with CIBC Global Asset Management. He stated, "The fund is designed to offer investors an institutional quality portfolio with stable income, underpinned by robust fundamentals in the sector." The strategy for the Canadian Core Multifamily Fund includes investing in newly constructed and substantially renovated multifamily rental properties. The focus areas include the Greater Toronto Area, Ontario's Golden Horseshoe, Greater Vancouver, Greater Victoria, Calgary, Edmonton, Ottawa, Montreal, and Halifax. With Starlight managing the fund, this marks a significant milestone as their first residential-focused, open-ended investment vehicle. Eric Bélanger, Executive Vice President and Head of CIBC Global Asset Management, highlighted the appeal of private real estate investments, noting that they offer strong diversification and attractive risk-adjusted returns. He expressed excitement about the strategic relationship with Starlight and the opportunity to provide clients with access to Canadian residential real estate alongside a leading multifamily manager. Starlight Investments, headquartered in Toronto, is a global real estate investment and asset management firm. It boasts ownership and management of over 70,000 multi-residential suites and more than 7 million square feet of commercial property space with $30 billion in assets under management. This partnership with CIBC signifies their continued commitment to expanding their multifamily real estate portfolio and offering robust investment opportunities. The Canadian multifamily market is navigating some challenging waters due to a confluence of new supply and ongoing trade tensions with the United States. According to a report by Oxford Economics, the national average asking rent in May was $2,129 per month, marking a decline of 3.3% from the previous year. This decline in rental rates is most pronounced in cities like Calgary, Vancouver, and Toronto, which have seen significant decreases over the past year. Oxford Economics notes that the completion of new multifamily units surged by 35% in 2024, rapidly adding to the country's housing supply. The report anticipates that this strong growth in rental supply will persist as a record number of purpose-built rental units are completed and integrated into the market. However, the demand side is experiencing a slowdown due to reduced immigration and fewer temporary residents, which is likely to temper the demand for rentals. Despite these challenges, there are silver linings. The report highlights that while demand might be curbed, the worsening affordability of homeownership and financial strains on households, exacerbated by the trade war-induced recession, will likely sustain a baseline level of rental demand in the coming quarters. This dynamic provides a certain level of stability in an otherwise volatile market. On the international stage, tensions between the United States and Canada over tariffs have added another layer of complexity. United States President Donald Trump has threatened further escalation unless Canada rescinds its digital service tax. The Canadian government, led by Prime Minister Mark Carney, has agreed to resume negotiations, with the aim of reaching a deal by July 21st. While this offers a glimmer of hope, the outcome remains uncertain. Tony Stillo, Director of Canadian Economics at Oxford Economics, warns that without an immediate resolution to the tariff disputes, the housing slump is likely to extend through the end of 2025. He suggests that poor affordability, weak consumer confidence, and job losses from the recession will continue to suppress demand. Stillo also points out that a shrinking population, due to immigration cuts, will further impact the sector, potentially leading to an 8 to 10% drop in average home prices by year's end. Meanwhile, CoStar Market Analytics offers some perspective on the multifamily market's regional dynamics. They observe that vacancy rates are nearing more balanced levels in highly unaffordable urban markets like Toronto and Vancouver, while moving towards cyclical highs in Alberta. This rebalancing could present opportunities for investors seeking to navigate these turbulent times strategically. As we explore the technological advancements in multifamily real estate, a significant development in the realm of flood and leak detection technology is making waves. According to a recent article by Franco Ferrauto from PropMoto, new innovations are safeguarding multifamily assets like never before. Water leaks and floods have long been a persistent threat, often underestimated, but they can quickly escalate into costly repairs, tenant displacement, and rising insurance premiums. Data shows that water damage claims for residences often run into thousands of dollars, especially when leaks occur behind walls or affect multiple units. In response to these challenges, building owners and managers are increasingly turning to new leak detection technologies designed to catch problems early, before visible damage spreads. These modern leak and flood sensing systems have evolved to become robust solutions for multifamily buildings, combining inexpensive sensors with artificial intelligence and automated shutoffs. Some of these systems deploy networked Internet of Things technologies that monitor water pressure, flow, humidity, or acoustics across entire buildings or multiple units. This enables operators to detect anomalies, sometimes as subtle as a single drip, and intervene in real time. Before long, these upgrades may become standard checks in the toolbox of any serious multifamily operator looking to safeguard asset value. At the center of this shift are smart sensors and automated shutoff devices. Even large fixture manufacturers are joining the fray. For instance, Moen has launched tools that attach to a building's main water supply line, continuously tracking water pressure, flow rate, temperature, and usage patterns. The technology is designed to learn what normal water use looks like for that building, and then flag deviations, such as a running toilet or a slow drip behind a wall. When the system detects something abnormal, it can automatically shut off the water main and send alerts to property managers via a web dashboard, mobile app, text, or email. This makes it far more effective than traditional leak detectors that rely on visible moisture. It also means managers do not have to wait for a tenant complaint or a business owner visit to discover a problem. Companies like LeakSense are building systems specifically tailored for multifamily real estate, offering networked leak detection with automatic shutoff and per-unit submetering. This allows owners to monitor water use and detect problems across shared plumbing lines or risers, making these platforms more scalable and better suited for high-density housing than home-focused products. Beyond conventional flow and pressure sensors, newer technologies are leveraging artificial intelligence and novel sensing methods to expand detection capabilities. Recent academic research has demonstrated ultra-low power acoustic leak detection systems capable of identifying very slow leaks from several meters away. These sensors perform signal analysis on device, preserving privacy and reducing bandwidth demands. The appeal of these leak detection upgrades is not just about avoiding disaster. The return on investment can be compelling. According to a report from a multifamily operator, deploying leak detectors across dozens of assets generated hundreds of leak-related work orders in the first year and prevented tens of thousands of dollars in damages. In high-rise buildings or older masonry structures, early detection and automatic shutoff may save hundreds of thousands or even millions of dollars for a single asset over time. Moreover, when leak detection becomes part of a broader water management program, it can decrease water waste and help meet regulatory or sustainability requirements. This is increasingly important in urban areas facing water scarcity or stricter environmental standards, potentially reducing utility bills or satisfying local water efficiency incentives. While installing these systems across a multifamily portfolio presents challenges, such as retrofitting older buildings and integrating with property management software, the direction is clear. Cheap sensors, smarter algorithms, and remote connectivity are making leak detection more accurate, scalable, and actionable than ever before. For multifamily buildings, where one small flaw can ripple across dozens of units, this technology offers a shift from reactive repair to proactive protection. In uncertain markets with aging infrastructure and tighter margins, preventing water-related disasters before they begin is not only prudent, it may become essential. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.